Hello, hello. Welcome to Clive Capital's bi-weekly webinar series where we bring on educational speakers from different industries, mostly in real estate, but also other wealth building topics as well, to keep you educated and informed and up to date. And a quick disclaimer before we get started. The information and topics being discussed here today are just for entertainment and educational purposes. We are not financial, tax, or legal advisors, and we recommend that you consult such professionals when making decisions in these areas. And with that, let's get started. Today we have Joe Scorese, a mortgage broker at LendingOne, a division of BlackRock. And we met at a networking event at the 40/40 Club here in New York City. And so we'll be talking about what the lending environment's looking like today in the real estate market and how you, as a real estate investor, whether you're new, have a little bit of experience or very seasoned, should approach this constantly changing market. And with that, Joe, let's get started. If you could introduce yourself, tell us how you got started in real estate, or what your journey's look like so far, and what you do today.
Sure. My name is Joseph Scorese. I'm a direct private lender, regional development manager at LendingOne, division of Blackstone Capital. So I know there's a little confusion between BlackRock and Blackstone, but Blackstone owns LendingOne. And we deploy debt financing for 30-year fixed on the rental loan, single family through four family, or multifamily and or mixed use. We'll look at new construction. We'll look at strategy, meaning one-time close, buy, renovate, rent, refinance, redo, fix and flipping, revolving construction lines of credit. We're a non-recourse or recourse lender. We also look at blanket loan, type of portfolio lending. So, and we're licensed in all 50 states. And I'm a licensed realtor in Pennsylvania and New Jersey. And I teach CE for licensed real estate agents in Cornell in New Jersey, Pennsylvania, Delaware, and Connecticut, and soon to be New York State as well.
That's quite the resume. And how long have you been in the industry?
I've been a licensed realtor since 1980. I've been a multifamily investor and owner since 94. I've been a licensed banker since 2001. And an accounting and economics background, which I graduated from Rutgers University in 92.
So you've been through, quite a few of these cycles and just different things that we're seeing in the market.
Yes. We saw a real nice 14-year run on the last 10-year cycle. So now we're looking at obviously reset and waiting for our eyes as the Fed is trying to take a handle of the inflationary issues that we have throughout the country right now.
Yeah, let's talk about that a little more, like what we've seen in the past few months and how it's been, like the interest rate hikes and how it's been impacting what you're seeing in the industry.
Well, I mean, the Fed has to make a significant rate hike this month to offset consistent inflation issues in various sectors of economics. The values of the real estate are topping, where it's literally getting out of the hands of the home ownership. We don't know what the REO foreclosure inventory is going to look like over the next 12 to 36 months and how that will impact by region or by market. And the rates need to slow down the entire environment of real estate because it's just frothing way too high. And, and again, hiring the Fed rate does not always correlate with the mortgage rate. It definitely impacts bank costs and costs on credit cards and other type of lending type of instruments. It doesn't always impact the mortgage environment, but it will slow down the cost of values going up in the real estate market, which will hopefully level things out for the home ownership over the next 12 to 24 to 36 months. But what it does is leave a window open for landlord loans in the asset-based lending environment. Because you got to remember, Kashav, in the past 3 years prior to the basis point hike over the last 6 months, 43% of the rental properties were gobbled up by homeowners. Okay. So you have a lot less rental inventory in the market available. And now you're starting to see some days on the market inventory starting to creep back up. When does high tide come in for REOs and foreclosures? Now asset managers have to get to work to start pushing some of that inventory to the forefront, whether for investor concentrate or home ownership. And that's why you're starting to see some million-like products rolling back out in the Fannie Freddie space, in the traditional lenders, to facilitate some of those upcoming REOs that are going to be hitting the market soon.
And for our listeners who may not know, what does REO stand for?
Like a real estate owned by the bank, like a bank REO. So as these banks are starting to get these tapes of properties to the forefront and getting them to the auction houses, or getting them to the share sales, you'll start seeing that inventory increasing even more so, depending on what market you're in.
Okay. And John, feel free to throw any questions you have in the meantime also. Joe, my next question, kind of leading from there, is how do you see these rate hikes so far impacting both home buying, from the everyday American, as well as investing?
So in regards to, we'll start with traditional lending. So traditional lending, if you were a loan officer or lender in the refinance environment, you just lost 90% of your business like that in a matter of 6 months. It's all gone. Okay. Imagine hundreds and hundreds of refis, over the past couple of years that were available with rates between 2 and 4%. Now that same rate, 6% on average, or high fives for them. So it's definitely getting more creative. I would say the attitude of the listing agent obviously has changed back to normalcy, where there was such a arrogance by list agents, making some grand demands of the type of borrower they want only to buy their homes. A lot of these buyer agents are extremely frustrated along with their buyers. That table has turned. It's turning as we speak. I mean, we're still in this quasi seller buyer market, but I think we're leaning more toward a buyer market as we move toward the end of this year. For the landlord, for the investor, they're looking at an opportunity where they are going to be able to, they're going to have to pencil their numbers down harder in regard to debt service coverage ratio and better understanding the income expense. And that means lowering their offers on properties, which will eventually start impacting the influence to a licensed realtor that's listing these properties and saying, hey, we can't take this higher number. It won't work from an investor perspective. And in regards to rehab and construction, you still have material cost issues, labor shortages, which is big. We're not seeing as much of a supply chain issue now. That has stabilized. Definitely see material cost ticks up, and labor shortages is still impacting completion of a lot of rehab lending out there to get to a stabilized property to either rent or to be resold to a homeowner. So there's still some fluctuation. I think things are going to need to still settle out into next year to really see how this 10-year reset's going to go. And then you're going to start seeing the REO listings and the foreclosures starting to come. And then all of a sudden now you got this fatter inventory, and who's going to pick up those type of opportunities? I think it's going to be more of a landlord play, because the landlord with asset-based lending, where it's not hyper-focused on tax returns or hyper-focused on the asset. And as long as the property debt service is correctly, accordingly, somebody could put 20 to 25% down and rent to somebody they probably outbidded that wanted to buy that home. They're going to end up renting the property because they couldn't afford to buy the home because they got priced out. And an asset-based investor can move quicker in acquisition, and they have more flexibility if it needs light rehab to restabilize it as an investment property than a consumer would be in the first-time home buyer or the home buyer segment.
And so, with increased competition from investors for single-family homes and these mortgage rates going up, do you see home affordability continuing to, or how do you see home affordability continuing to play out for the everyday American?
Well, there's going to be a pivot. I think you're going to see more consumers moving areas where they can have better barrier of entry because now they can work virtually where they maybe had a 90-mile restriction to where they could live, work, eat, work, and live. Here, with now everybody working virtually, working off site, there's not the same type of restrictions to the HR letter where you have to stay within a certain amount of proximity to where your job is. Individuals are going to start moving to areas and migrating to markets where they can afford. We're starting to see that in the migration reports that were released earlier this year from Penske and U-Haul, seeing some of the markets where a lot of the people were moving to. Obviously, 10 of the top cities were Florida, 6 were in Texas, a couple were in Wisconsin, Carolinas were there. So again, you're starting to see this migration to better markets for them to afford.
Okay, that makes sense. And as let's say you do want to stay in the same place, but homes are becoming more expensive. Walk us kind of through what that means for the rental market.
Well, I mean, you're starting to see a lot more development in the eat, work, and live environment. You're seeing developments coming back into the urban cities to attract back into the cities because there's been such bad publicity of crime, which is still very high in most of these urban cities throughout the country. But what they're doing is trying to leverage transportation, meaning bus, to where a lot of these developments are. So I can give you an example in the smaller cities. In New Jersey, they're building out a 440 unit mixed use eat, work, and live building neighboring a mass transit stop. Now, again, it's in the urban cities. There's a certain type of person that wants to move back into the city or need to be convenient to the city for whatever type of position they hold. But how does that impact also the single family residential environment and multifamily environment in that same market when you bring another 440 units to that neighborhood? What does that do? Is that good? Is it bad? Does it level off the rental playing field? Does it bring down rental increases that are at 14 to 40%, depending on what market you're at, in rental increases throughout the country? So does that level off the playing field? I mean, we'll need to see that. That's going to be more of a 3 to 5 year play because that building doesn't even exist yet. So we don't know how that's going to impact the rental market just yet. But we'll see how that will impact over the next 24 to 36 months. But if you travel, which I do throughout the Northeast, all the major thoroughways, you're seeing eat, work, and live buildings being popped up, and the rental market is more prevalent. The 50% of your home buyers, the millennial, and they are not compelled to buy a home. They're not looking to landscape a house. They're looking to go home from their job and walk their dog on where the amenity is, where the green park is, and go home and watch TV, or go locally to some restaurant or facility within the complex of what was built out. So a lot of these eat, work, and live environments are providing a different amenity base where it's detracting the idea of owning your own home and just let somebody else take care of your environment.
Yeah, I mean, we're seeing a lot of that too, and that's why, half of our business strategy is build to rent, like you talked about, where we'll build these homes in subdivisions of communities instead of selling them to people like you or me, we'll rent them out. And so our tenants, they don't have to worry about fixing, broken ACs, or if they need to do landscaping, or, if the stove stops working, that's not a headache for them anymore. That's something, that's on the landlord.
I would agree. And you're going to see that grow even more so over the next 5 to 10 years.
Yeah. Yeah. And so that's,
And
go ahead, John.
I was going to say, and that's a change from a year ago when a lot of the single family home purchases were coming from millennials, right? Because they were looking for those places to stay before COVID hit. Millennials were buying up the single family rentals, single family homes rather than now, as you say, they're just not compelled to buy them any longer.
No, they're going to look at more of a community type of environment with amenities to be taken care of, and they'll wait. I mean, listen, in my lifetime, in my career, I don't think we'll see 2% again. But hey, I don't have a crystal ball. But will we potentially see 3-4% back? Yeah, I think that millennial that missed the window and some of their fellow colleagues and peers took advantage of that. They're going to wait 5 years or 3 to 5 years, unless they're pressed to buy a home because they're having children, education, schools. Those people are just not going to stop buying. It's just going to be a different type of buyer. It's not going to be the 17 people lined up to make an offer on a home and the realtors waiving appraisals and inspections. There's going to be a little more work to be done, a little more data need to be done by the real estate professional to sell that home or be a better buyer agent, and then for the investor, I'm going to identify markets where consumers are willing to pay that better rent, maintain that home or that complex or that that multifamily property better for me, where my deferred maintenance makes sense to hold that property out and not sell it in the open market. So there's a couple moving parts here where it benefits all parties, but it all leans back to the investment space, especially when it comes to bills. You're looking at debt service coverage ratio type of loans where the rental market's going to stay extremely frothy. I think you're going to have some shifts in the urban markets over the next 5 years due to crime stats and activity, where you're going to see the suburban market staying very strong, both on buying on home ownership, but also landlords renting to Class B plus A renters. How does that impact also low income housing? Class C rentals. There's going to be a shortfall there because with rental appreciation between 14 to 40%, is there any room for the Class C or low income housing opportunities?
And so that kind of covers the single family side of things, but what are you seeing on the commercial side, whether it comes to multifamily, storage space, triple net leases, et cetera?
Well, I'll just touch on multifamily. You're probably going to see a lot of assets that are more turnkey on the market next year because of syndications or younger investors that probably made the deal work, but did not estimate a 200, 300 basis point shift in the rate within their 5-1 arm or their 7-1 arm. So you're going to see some assets throughout the country being sold or potentially going to foreclosure, because how is that investor going to pay back the investors that paid into the syndication if the debt service is not there to recover that difference of forced equity? Because now instead of 3.5%, you're at 6%. So it's less leverage allowability on that asset. You're starting to see some foreclosures in some of the larger multifamilies throughout the country. I think there was one in Philadelphia, but they have poor management. So that's probably one reason why they're in foreclosure. There's one in Virginia, one out in Alabama, and one in Texas that are, you're starting to see some of the bigger Fannie Freddie multifamilies foreclosing or in delinquency at least 90, 120 days. But what about the properties that are, the middle of the road, the 20 to 100 unit type of environments where it's just a basis point shift in the rate where it's still a great asset, but there's no value add, but they're going to have to unload it because they can't pay back their investors unless they sell the property to somebody that's going to buy a turnkey. So, and there's plenty of money out there up to 80% debt leverage, as long as the debt service supports the buying of that asset. And no one's going to overpay in the multifamily space if there's not a hell of a lot of value add. So the concern I have is ones with the light mixed use or office retail. What are they going to do if those units are empty? And how are they going to pencil that into factoring the debt service coverage ratio is my concern. As inflation's still 8, 9, 10% in most markets or even higher, depending on what the media is allowing you to hear, how is that going to impact retail office space, mixed use space to those buildings? I would be very concerned if I had mixed use space. I'd be looking to convert those to residential living and let the retail be retail, let multifamily be multifamily. And as we were briefly talking to Shab, I was at a meeting last night in New York, and I'm seeing I'm just using New York as an example. There's definitely a high concern of vacancy in the commercial spaces because these are older buildings, 75, 80 years old. 40 or 50% of those buildings are owned by the same family as they were built. What are and all the 35 of those people that have ownership in that building and began to check for the last 30 years. Now we're doing a capital call of $200,000 to refurbish the building to accommodate what is available out there for opportunities. And, they're not going to put that money up. So there's going to be a lot of negotiations on how the renovations are going to be done to those buildings, who's going to occupy those buildings, and how the negotiation will be for the lease, whether it's triple net or, they're going to allow a discount to the investor to do the renovations themselves and take a discount on the overhead on the occupancy of those buildings, if that is the case. So I think commercial is going to have a rocky road over the next 36 months. Self-storage, I mean, it's going to be depending on where you're at. I'm seeing a lot more multifamily investors. If they can actually put a self-storage facility as an amenity on their properties, they're leveraging that for for additional revenue streams. But as material costs are still not coming down, you're starting to see some stagnation in the self-storage environment as well, depending on where you're at throughout the country. And then light industrial warehousing, that's going to stay very strong just because, the Amazons of the world and data centers of the world. I mean, how many data centers can be built out in these commercial buildings in the inner cities? So again, it's going to definitely be region by region. I think your Northeast is going to be impacted the most, then your West Coast, and then, Central, like the Illinois area, that area is going to be impacted. And then Southeast, Southwest, they're doing quite well. I mean, an investor was on a panel last night. They're investing in Phoenix and they're in New York. That just tells you they're taking their money elsewhere. So they know they can't trust their own market right now. So they're looking at Miami, they're looking at Phoenix, they're looking in the Carolinas, they're looking in Georgia. And then now you have these transportation enhancements in certain markets where they're extending or strengthening the train transit. That's going to impact a lot of these smaller cities and bring hopefully some residential impact and commercial impact to the smaller cities that tie into those new added transportation routes.
This is the Amtrak expansion, right?
Yeah, I mean, I can think of two right off the top of my head. The one that's talking about in Macon going to Atlanta, that's going to enhance the whole corridor. And then the Miami to Orlando is going to be another huge move. I mean, that's just two. There's others. I mean, just think of the two off the top of my head.
Yeah. And
so opportunities, I was going to ask, opportunity in commercial, sounds like light industrial is certainly one of them. Multifamily, you have to be much more specific about your local markets and underwrite conservatively, underwrite well. How about something like other triple net leases apart from light industrial? I'm thinking manufacturing that would probably still be under the same constraints for materials, not so much supply chain, but what do you think were there the opportunities?
Well, I mean, where's the labor? Where are you going to find a qualified? All the other stuff is great. Labor, supply chain and material cost shifting, but where's the qualified labor moving? Like, where's the migration telling us where people are or that are qualified that are going to be able to they're going to afford to live and work neighboring these manufacturing outfits, right? So I'll give you a great example in the Pennsylvania market. Everybody moved up into that central west market because it was inexpensive to live. You could still travel down to the city, New York or Philadelphia for that matter, for a higher paying job. Now these manufacturing warehousing is all moving up there because it's lesser expensive, and there's this huge labor force, and that next generation that was developed by families moving up. Now the better jobs don't have to go all the way down to the cities now anymore. They could stay into the urban, rural, suburban market for that matter. And there's a better talent pool. So again, that's just one example of many different markets throughout the country. Like who would have thought everybody was moving out of Chicago and moving over to Madison or Milwaukee, Wisconsin? Like who would have thought that was two of the higher migration reports, last year, in both Penske and U-Haul. Why? Because they people don't want to live around getting shot. You know what I mean? So it compels them to leave. So they're going to go into an area where, one, the barrier of entry is easier to get into. Two, there's opportunities and there's safety for themselves and their children and their families. So it all kind of rounds out for safety, quality of life, and affordability. And that's why, like in New York State, doing much better right now. New York City, everybody's moving up into the New York State market. So I'm just using examples in the Northeast. I think the same relevancies, to any state we could break down statistically. Like, I mean, 10 of your top migration in the top 25 were in Florida. I mean, I wouldn't move to any of those cities right now. They're saturated. I think 6 are in Texas. I wouldn't move to any of those in Texas. They're saturated. Why would I go to where everyone else is going? I don't want to go downstream with the whole school of fish. I want to go the other way. So you have to, as an investor mindset or real estate professional, you have to look at being that individual going the other way. Like I know there's 3 really hot markets in Ohio, right? I have investors looking at the 2 that are not hot before they get hot. So they're trying to get in as quick as possible and identify before those markets appreciate to the level of the other 3 markets that are out there. Okay, so it all depends on where you're at.
In addition to looking where others aren't looking, what other advice would you have for investors in the market that we're seeing currently?
Don't be so excited. I mean, if you're going to pick a market that you like, that you think the barrier of entry works for you, you better be there once or twice a month and building out your power team before you go boots on the ground and do a lot of homework. Join some associations, more of a trade show. I wouldn't say go to the local investor group event. I would go to the higher level 202 industrial environment, events that are in that market. Like I would go to just realtor associations, trade show associations that are tied into those markets. Those are the individuals that are going to give you a better grasp, higher level, how the whole market's doing. When you go to these smaller investor group meetings, it's more of a rah-rah, drink the juice kind of thing, and they'll sell you whatever you want to hear. So I want to hear I'm more statistical. I want to see real numbers. I want to see real professionals telling me how it's impacting their bottom line and their companies as well. So I'm going to do a higher level research and be like, when I get into a market, like I'm doing some work down in the Virginia market, I look at population increases, I look at the rental increases, I see the labor forces, I see the schools, the universities, how they're impacting. And I say, okay, that makes a lot of sense. I'm going to go there once or twice a month. Started tying in some clients with me and myself there. Oh, I see the New York market. I'm going to meet gentlemen like yourself that are investing everywhere else but New York. They got money to work with, but they're investing elsewhere. Those are the type of people I want to work with because I'm licensed in all 50 states and I have the data software to better understand whatever market they're going into because of the type of company that I work for and represent. So I'm looking to identify a more qualified individual. So I need to kind of do my research consistently. And as an investor, you have to do the same thing, whatever market you're going to go in. I wouldn't just depend on Facebook on identifying your market. You know what I mean? I'm not trying to throw Facebook under the bus, but I'm just saying that it's just a little more dig that you're going to have to do.
When you're underwriting these deals, what kind of measures or risk mitigants would you recommend people have? Again, on the single family rental side and the commercial investing side.
I mean, I would definitely take a hard look at deferred maintenance. I would take a hard look at management. offsite, management maintenance groups that are in that area. I'd also take a real strong look at the landlord tenant laws for where you're investing. You can really get caught with your pants down if you're in a market that is, how might we say, communistic and favorable toward 100% toward the tenant. You're going to be in a lot of trouble as a landlord if you're out of state landlord and you're depending on everybody else but yourself in successes to your real estate portfolio. So you got to be hands on. So you better know the laws. You better have a consultation with a active eviction attorney or landlord attorney that's in that market. I mean, I would highly suggest going to an eviction court in that market and seeing who's winning and losing in eviction court and start setting up meetings with those individuals for your growth and for your knowledge as well into that market. Understanding landlord tenant law and wherever you're investing in is going to be high priority to grow and scale.
Yeah, I mean, during the pandemic, we saw a lot of people in cities like, I believe, San Francisco, New York City, just go months without paying their rent, and it's just
how about years? How about years? We're still at years in some markets.
And it's just, yeah, in those markets, it's just really hard to do anything about it if the government's not on your side there. So really, markets.
You have professional tenants. They know they can get around the system. So you need to identify markets that hopefully find favor in the balance in the middle. I mean, there's some really bad landlords too. So, you can't fall on either side too heavy, but you should have a happy middle. And in some of the urban markets, at least in the Northeast, they're just terrible right now. So I wouldn't. I'm not going to be a big fan of unless you really have experience in the right power team. I wouldn't dive into some of those markets unless you know what you're doing.
Yeah, exactly. Yeah, a lot of people ask me whenever I tell them I'm a real estate investor, they always ask me where I'm investing in New York, and I'm like, I just like living here. That doesn't mean I'm going to invest here.
No.
Yeah.
Yeah, and I could tell you from the appetite in the room last night. Yeah, everybody's looking everywhere else. I mean, a lot of these commercial realtors they're pivoting. They're trying to figure out how to stay above water and sell something that's going to be very hard to sell over the next 3 to 5 years. I mean, it was extremely it was really nice to walk around the city last night and the hustle and the bustle, but you could definitely see a different feel in some of the commercial buildings, the emptiness. So I really not hoping for the bad, but I'm really hoping to see what happens and what's gonna chameleon in some of these buildings throughout the market, such as New York, because it's always been able to rebound by some crazy events that have happened over the past 20 years. But I'd like to see what happens here now and what they're going to do to grow out in a different direction.
Yeah, that makes sense on the investor side. So let's switch over to just residential home buyers. What would you recommend for them going forward?
I definitely would make sure a couple things. One, having a home warranty. You're buying these homes now, especially if it was flipped. It does protect you in having a home warranty on the property. Getting a good inspection on the property, vetting everything through if it's a rehab property. Not overpaying. I'd probably say below your market. I'd say live below your means, not above your means. I see too many homeowners not having proper reserves to even cut the grass, for that matter. I mean, I was at a meeting, I think it was on Wednesday or Thursday, where the woman is a licensed loan officer, and she basically gave an individual a loan on a house, and the homeowner cannot afford to do any type of landscaping, any type of work on the house, no paint, nothing. She has no money. Every last penny went into buying that house. Is that a great thing or is that a bad thing? What are the odds of that individual losing the property in the next 12 months? Very likely, with one bad month. So did that loan officer do right by that individual or not right by that individual? It's all about how you make your living, because we all work off of commission and salary and all circumstances and production, but putting somebody into a situation where they can't afford to, plant plants in front of their own home, was that a smart move or a bad move? You tell me.
Right.
You know, so they put them into a house, no reserves. So if there's one bad thing happens, they're in foreclosure.
Yeah.
I don't know. Now she's looking to get people to volunteer to donate their time and money to help this woman that bought this home because she can't afford to do anything. So what I have no problem donating towards circumstances, but I'm not the Red Cross. And you're the one that put them in the bad situation. You should be donating back your commission for all the landscape work that you're claiming that it still needs to be done on the property. But you didn't want to hear that.
Yeah.
You know,
With
so
with the interest rates continuing to rise over the next year, possibly longer, and ARMs being adjusted rate mortgages being lower, do you think ARMs are a good idea for homeowners, or do you think the market, the long-term outlook for interest rates just is that, and even 5-year ARMs will not cut it? You want to look even longer.
I'd probably say, are the ARMs that much less expensive? Oh, I mean, are we talking maybe a quarter point to a half a point? I mean, in the grand scheme of things, it's really not much of a difference. If I was going to look at an ARM product and save a little on the rate, and maybe look at a 10-year, you probably can get past a lot of this craziness that's going to happen over the next 5 to 7 years. I'd probably take nothing less than a 10-year ARM. I'd still work my numbers and whittle down harder at a 30-year fix and take the worst case. If you listen to the 8-minute presentation by Federal Chair Powell at Jackson Hole, he brought up the previous Fed chair from the late 70s, early 80s, and how he raised the Fed rate up to 20% to bring down inflation. He brought them up twice. So they are going to stay extremely neutral to get inflation under control. They're not going to have government influences. All these senators and congressmen and president, vice president, say whatever they want. Not going to do a thing. I mean, you're passing laws claiming that you're sustaining inflation when inflation rate is still at 9-10%. Obviously, the Fed sees that, and they're going to keep raising the rate up to balance that out. I would not be surprised if there's not at least 2 3/4 raises to the rate this year. So one's coming up on the 21st of September, I think. I mean, all indications show it. And then I think there's going to be another hike before election in November or right around election. So, there's no way to disguising this. There's no skirt or makeup that you can make this pig look any differently. Okay, it's still going to be a pig. So, from a market that we saw very robust growth in the previous 14 years, to literally eat all that away and see dips in household net worth decrease across the world in a matter of months, 6-month deterioration, the Fed has to do something to slow it down and allow it to repivot.
That sounds good.
I actually have a follow-up question to that because stock market cycles, the bull cycles, the recessionary cycles, we've seen recessionary cycles lasting a year, 2 years, maybe 3 years at most over the last 50 years or so. But how's that compared to the down markets for real estate? In previous years in the 70s, they lasted a very, very long time. But more recently, how have the recessionary markets, the down cycles for real estate been? How long have they lasted?
Well, I mean, typically it's anywhere between around 24 months to 36 months. Some markets recover, they get in sooner, and they impact sooner, and they start impacting on the positive end, on the back end soon. So I think Wall Street saw this coming. I was at an event a couple of years ago where somebody outlined that the Wall Street was like 40% bloated over value. They used a great example of Tesla. Tesla's stock at the one time was worth 10 times more than all the other car industry stocks combined, and they only do 1 million of the 50 million cars distributed every year. You knew there was a problem there. Why do you think Wall Street is backing direct private lending in the non-QM space? Why do you think that? Because they know that they're not going to see the same returns on Wall Street, and they have to find another investment engine to facilitate the relevant returns over the 30 years. And what has always been traditionally anyway? Real estate. So they created their own industry called direct private lending that went right down the middle. It literally just pushed out traditional lenders out of the way and hard money lenders out of the way and just said, hey guys, how are you? Here we are over the last 10 years. And then in the past 3 years, everybody's a direct private lender. Suddenly all the traditional lenders have non-QM products, because if they don't, they'll hang themselves on poles with no business. So all these traditional lenders now suddenly become non-QM experts, and they're not, because they've only done traditional lending. They only understand personal debt to income. To understand commercial lending in the residential investment space is an art form. So I'm very blessed that I saw this pivot and got out of the regional banking market, because I was more resi commercial loan officer anyway. And when this regional development mission presented itself, I mean, it was a no-brainer, because I saw the market shifting. I said, there's no way we're going to stay doing hundreds and hundreds of loans at 2%. It's numerically impossible. How long can you give away that money so inexpensively? I actually locked a client of mine. He came up to me. I just saw him at a trade show. He goes, I can't believe you locked me at 1.75 with a 2-point buy down for the next 15 years. I mean, how is that bank making any money on that loan right now? They're not. They're at a loss. So all these banks are licking their wounds from giving all this cheap money away. That expense has to come back. So now all of a sudden, the traditional lenders are going to have to jack up their pricing and costs. Same with hard money lenders, because they're more individually backed. They're not typically backed by hedge funds. And now you have all these hedge funds that were in the Wall Street market, and they're seeing huge returns over the next 30 years, investing all their money in a field, not that it's not regulated, but it's definitely going to be a unique asset-based environment for the next decade. And all that pricing is now relevant. Like if you go to a commercial bank, it's not much than a direct private lender on the same loan. The only difference is we're giving longer term money than a bank can. A bank can't give money away for more than 5 years, 7 years best. They need their money back. No commercial investor is going to want to only tie up their rate for only 5 to 7 years, because there's a huge uncertainty. They don't want to get caught not having a rate or option 7 to 10 years down the road.
That makes sense. Any last thoughts that you want to wrap up with here, Joe, as far as what investors should watch out for in these upcoming months, or even, the next year or two, as far as opportunities and risks?
I mean, listen, pencil your deals down harder, leave contingencies into place. Just don't do a rehab loan without using a 10 to 20% contingency in your costs. I see too many investors not using a contingency in their rehab lending environment. They get caught. Being properly reserved, having that powder, of liquid reserves or cash reserves, partnering with the right people, making sure you're vetting them, and also building up the power team wherever you're going to put your boots on the ground to win long term. Okay. And again, that's going to be that's another difficult thing. And how do you vet individuals? But surrounding yourself with various options. I'm not saying I'm the only game in town, but you need to talk to your traditional lender. You need to talk to your hard money lender. You need to talk to your direct private lender. Have several direct private lenders, because there's like myself, I have a pricing engine. Most higher level direct private lenders have a pricing engine where you can price your scenarios out and have better rapport and communication with your lender and with your borrower. So communication is going to be huge. It's not going to be like, I know everybody wants to text each other. I'm all about talking to somebody. I want to take 15 minutes with somebody and get to really, really know them. So communication is always going to be the key factor, and old school will always win. the turtle always beat the hare in the race. So you don't have to be the fastest person in the business. You got to be the smartest person in the business.
Thanks. Yeah. John, any wrapping up thoughts?
Nope, that's it. Thank you very much for your time. A lot of great insight and information that you've imparted. So thank you very much for that.
And gentlemen, I extend an invite back to both of you again. If you ever want to put a subject together on a Clubhouse that we had, Shav did a great job a couple of weekends in a row this past quarter. If you guys ever want to come up with a couple of subjects, have you back on for some Q&A, I'd love to have you back on as well.
That'd be great. Yeah, definitely. And so for our audience, who do you help? How do you help them? What can they reach out to you for?
Basically, I love to sit down from a call to action to better strategize and discuss how you're going to grow in the business, whether it's your first transaction or it's your 100th. There's always a golden nugget to learn in communicating with a very transactional lender, investor, licensed realtor. That's going to be very transactional. Somebody that really understands what you're going through. So having that call to action discussion to build out strategy is going to be extremely important. That's what I can offer anybody that's listening into that.
And what's the best way to reach you?
215-290-5108 or J Scorese, JSCORESE at LendingOne.com, all spelled out.
Okay, great. Yeah, I'll include that in the description when we upload this to YouTube and anywhere else we post it up. But in the meantime, thanks for taking the time to join us today, Joe. Definitely a lot of good nuggets here in the conversation. And looking forward to meeting up with you and catching up here in the city.
Absolutely. Gentlemen, thank you very much. Have a blessed day.
Yeah. Have a good weekend, everyone.
Thanks, Joe.
Take care.